Hey, this is Todd. You're on the affluentology.com page. I want to talk to you today about 401k loans, and I am not a fan, and I'm going to explain to you why. So there is a massive hidden cost that people don't realize, and the reason they don't is because they don't feel it until much later in life. So as you know, my whole goal is to help people find ways their money can work for them so they don't have to work for their money anymore. Long and short of it, for the majority of us, it's I want to figure out how you can retire younger with more money. Taking a 401k loan is absolutely not going to help you with that. So with that being said, we've talked before about the 3 boxes you need to check when you're getting a mortgage. Box number 1, do you pay people back that you borrow money from? Box number 2, do you have the ability to pay this loan back? And then there's box number 3, which is how much money do you need versus how much money do you have? And the more money you put down, the lower the risk to the bank. Therefore, the better rates and terms that you get on a mortgage. But in no way, shape, or form will putting money down if you borrowed it from 401k be cheaper than just borrowing more of the money and putting less down. So let me tell you a little bit about why. So the biggest problem that I see is because of the taxes. The taxes are going to be massive. So when you think about it, when you put money into a 401k, most of us, and I'll just use $100 here, most of us put it in tax deferred, which is good because you haven't paid any taxes on it. Now, when we look at the tax brackets that we've got right here, and I just pulled up 2025 federal income tax bracket, and I am going to use the 22% income tax bracket here for married couples filing jointly. And the reason I'm going to do that is because I did go out and do my research on the mean family income, and I looked at where things are across the board. And the bottom line is it basically tells us that the average person is going to fall into that 22% income tax bracket because they're going to make more than $96,000 as a household. So I guess if you were thinking, well, I'll be specific here, 96.9, right? So I'm going to stop this. If you are in Kentucky or any of these other states, you're good. I guess if you're in Arkansas, New Mexico, West Virginia, and Mississippi, you don't need to, this would go down, honestly, not that much. It would go down to the 12% tax bracket from 22, but I'm a little off topic. All right, so here we are. We've got your tax deferred money that you've put in there. Now, what I'm going to do is I'm just going to take this $100 and I want to make sure it's fairly well represented here. So I'm going to fold it up into 4s. So these are in quarters, right? And so this is 1 quarter right here. And it's not going to be exactly a quarter. It's going to be about 20%. So this 20% is the 22% in taxes. And here's why I'm doing this. That means I'm only left with this much of my 100, right? The rest of it's going to be gone. And the reason that is because when you borrow the money, you're borrowing the money in pre-tax dollars. But when you turn around to pay that money back, you've got to pay it back with taxed dollars, post-tax. So now it's essentially like I've got a 22% interest rate on the money that I borrowed from myself on my 401k. Now I know there's deferred savings or lost investment money, and there's a whole bunch of other reasons that people say it's not a good idea. I don't care about any of those. Those are all speculative. What I do know is the taxes are a real thing, and that is going to impact us. So in looking at that, I want to save that. Well, now you retire. All right, I'm retired. And let's say I'm in the 12% income tax bracket at that time because my total income household is going to be under the 26%, or I'm sorry, that $96,000. So it doesn't matter. I have to lop off. Now I did these in quarters, right? I got to lop off another 10% of this. So here it goes. There we go. Here's the other money that is now gone, lost, because I just paid double taxation on my money. Here is what I end up left with. Now, does that look like a mortgage of 7%, 6% on the total cost of it? No, this right here, this pile is a lot more than 7% in an interest rate on a mortgage because I didn't put a huge down payment down and had to incur more interest. So definitely not worth borrowing from the 401k. Now, why does this happen? It happens because when you go to retire and you're withdrawing the money, the pre-tax and the post-tax money have been commingled. They aren't going into two separate piles. So nobody knows which dollar was put in pre-tax and which dollar was in post-tax. So they're going to tax you again on the entire pile. And it's going to be anywhere in the neighborhood. Just add them up. You're looking at a 34% total tax on a 401k loan versus tax deductible interest if you simply borrowed more money. So that's why I'm not a fan. For more tips, subscribe, pay attention. I'll be popping stuff in here every once in a while, but this one really gets to me. Once again, my goal for you is I want to help you to retire younger with more money. And I want to find ways your money can work for you so you don't have to work as hard for your money anymore. That's it. All right, man. Take care.